Most people think that the housing market only changes when interest rates move. That assumption is already costing buyers and sellers money in 2026. Right now, decisions are being shaped by things most people are not tracking: loan structure changes, insurance costs, property taxes, seller equity behavior, and a supply imbalance that looks stable on the surface but is not functioning normally underneath. Now, if you're buying or selling or even deciding whether to wait, this matters because the 2026 market is not behaving like previous cycles, even when prices look familiar. Before getting into the details, here's one important clarification. This video is based on research and market data and is not intended as legal advice or personal opinion. It is not meant to steer or discourage anyone from any particular location. Always consult with a licensed real estate professional about your specific situation. With that being said, let's get into the video. Now, the first misconception to clear up is the idea that the market has stabilized. Prices may appear stable in many parts of Maryland and surrounding state line areas. Days on market may look reasonable. Some buyers are also seeing fewer bidding wars. That does not mean that the market is balanced though. What we are actually seeing in 2026 is a structural imbalance between who can sell, who needs to sell, and who needs to buy. The distinction is critical though. Many homeowners are locked into mortgage rates below 4%. That creates what economists refer to as a rate lock effect. These owners are not reacting to market pressure the way that sellers did in prior cycles. They are not forced to move unless there is a life change, so supply stays artificially constrained. At the same time though, buyer demand has not disappeared. It's simply shifted. So buyers are more payment sensitive than price sensitive. That means that monthly cost matters more than the headline price. And this is where people kind of get confused. A home can appear affordable based on price alone and still be financially risky once taxes, insurance, HOA fees, and loan structure are actually factored in. In Maryland specifically, property tax variation by county plays a much larger role in payment outcomes than many buyers realize. The same priced home can produce very different monthly obligations depending on the jurisdiction. Now, this is also relevant for buyers considering Northern Virginia, DC, or other areas near the Pennsylvania border. Crossing a state line can change taxes, insurance requirements, and loan limits in ways that directly affect approval and cash requirements. Now let's talk about financing because this is where the 2026 market quietly changed. Now, mortgage rates are no longer the only variable buyers need to watch. Loan products themselves are evolving. In 2026, we are seeing increased use of temporary buy downs, adjustable rate structures, and hybrid loan products. Now, these tools are not inherently risky, but they do require precision. A temporary buy down typically lowers payments for the first 1 to 3 years. Now, that can be helpful if income is expected to increase or refinance is planned. Now, it becomes risky if a buyer is not prepared for the payment adjustment. That part actually matters. Many buyers only focus on the starting payment and do not actually fully plan for the reset payment. In a market where a refinance timing is uncertain, this creates a lot of exposure to you. And this is why pre-approval alone is not enough. Buyers need scenario planning. Now that includes understanding worst case payment outcomes, not just best case assumptions. Let's shift to sellers because seller behavior is one of the biggest drivers of our current market dynamics. Many homeowners in Maryland are sitting on significant equity, but equity is not liquidity. This is another area where people make incorrect assumptions. A seller can have 6 figures in equity on paper and still struggle to move if replacement housing costs are too high. This creates the hesitation. Some sellers delay listing because they do not see a clear next step. Others list but remain inflexible on pricing or terms. So this leads to a market where well-priced, well-positioned homes still move, while others sometimes remain stagnant. Pricing in 2026 is not about chasing the highest comparable, it's about positioning against current buyer psychology. Buyers are cautious and they're calculating risk. They are also comparing total monthly costs and not just the list price. So homes that fail to account for these things often sit longer, even in otherwise strong areas. This is where sellers need to understand options beyond a traditional timeline. Some sellers benefit from rent-back agreements, others explore delayed occupancy strategies, some even consider selling and renting temporarily to preserve the flexibility. These are not sale tactics, they are planning tools. And they are increasingly relevant in a market where timing matters more than speed. Now let's address inventory because this is often misunderstood. Inventory levels in Maryland and nearby regions may look healthier than they did during peak competition years, but the composition of that inventory has changed. More listings are coming from estate sales, relocations, and investors exiting properties. Fewer are coming from discretionary move-up sellers. This affects condition, pricing strategy, and negotiation leverage. Buyers should be expecting greater variation in property quality. Inspections matter, and repair budgeting also matters. This is not a market where skipping the due diligence is rewarded. For sellers, this means competition is less about quantity and more about quality. A well-prepared home still stands out. An overpriced or poorly positioned home does not get rescued by scarcity the way that it once did. Now let's talk about risk. because avoiding risk is one of the primary motivations driving buyer and seller decisions right now. For buyers, risk shows up in affordability volatility. Insurance costs have increased in many regions. Taxes are reassessed regularly, and HOA fees continue to rise. This is especially relevant for buyers relocating into Maryland or across state lines. Upfront affordability does not guarantee long-term affordability. Buyers should be evaluating not just today's payment, but future cost trajectories. For sellers, risk shows up in timing miscalculations. Waiting for rates to drop may not produce the expected outcome. Lower rates can increase competition and push prices upward, but they can also reduce negotiating leverage. This is not a linear equation. Market shifts do not move everyone forward at the same time. Now let's address creative selling options, because this is an area people hear about but rarely understand clearly. Creative options are not shortcuts. They are structured alternatives. This can include lease options, seller financing in limited scenarios, or delayed settlement arrangements. They're not appropriate for every situation, and they do require legal review and professional guidance. But in certain cases, they provide flexibility where traditional transactions do not. This is especially relevant for sellers with significant equity who want to control timing without fully exiting ownership immediately. It is also relevant for buyers who are financially strong, but temporarily constrained by timing or liquidity. Again, this is not about persuasion, it's just about understanding tools that exist. Now let's talk about decision making, because this is where people tend to freeze. In 2026, uncertainty is not a signal to stop, it's a signal to plan more precisely. Buyers should be asking, what is my maximum comfortable payment, not my maximum approval? How long do I realistically expect to hold this property? What happens if my income stays flat longer than expected? Now sellers should be asking, what is my net outcome after taxes, fees, and replacement housing? How flexible am I on timing? What is my backup plan if the home does not sell immediately? These questions matter more than predictions. Now let's address geography, because this channel does focus on Maryland while supporting broader needs. Maryland remains a complex and diverse housing market. County level differences matter. Tax structures matter, zoning and inventory constraints vary significantly. The same is true when comparing nearby regions in Northern Virginia, DC, and Pennsylvania border areas. Buyers and sellers should avoid assuming that proximity equals similarity. Cross-border transactions often involve different loan limits, taxes, and legal processes. Now, this is where professional coordination matters, especially for people relocating or selling in one area while buying in another. Now, let's talk preparation, because preparation is the difference between reacting and deciding. Buyers should be preparing by reviewing their credit, liquidity, and long-term goals before touring homes. Sellers should prepare by understanding true net proceeds before setting a price. This reduces stress, it improves outcomes, and it prevents rush decisions. Now let's address referrals, because not everyone watching this video will buy or sell in Maryland. Some viewers will need guidance in nearby state line areas. Others will need help elsewhere in the United States. This is where coordination matters. Working with professionals who understand local dynamics and can connect you with trusted agents elsewhere helps maintain consistency and reduce risk. If you're considering buying or selling in Maryland or nearby areas, or if you need help connecting with professionals in other regions, those options exist. If you want a general overview of Maryland resources, you can download the relocation guide link below. And if you want to discuss your specific situation, you can schedule a call or fill out the contact form on my website. The goal here is clarity, not pressure. The 2026 housing market rewards informed decisions. It penalizes assumptions. And understanding financing structure, equity dynamics, timing risk, and geographic variation is no longer optional. That knowledge protects buyers, it protects sellers, and it creates better outcomes regardless of market direction. That's all I have for today's video. I appreciate you so much for taking the time to watch, and I will see you on the next one.